Dollar yen. Here the situation is interesting and it looks rather beautiful. We can see that this daily Ishmael cloud put weight on dollar yen and prevented it from rising above 115 mark this month, and then the prices reversed to the downside. Also, we have the negative intersection of the moving averages. The 50-day moving average went below 100-day moving average, and the pair slipped below the Fibonacci level at 111.50. So next target lies at 109.33, and we have this daily moving average at 108.20. This is the picture on the daily chart. We can see that the basic conclusion is that dollar yen has left its previous range of several weeks, range between 111.50 and 115, and now it looks more vulnerable to the downside to the levels between 109 and 108. If we try to analyze fundamental picture for the US dollar Japanese yen, it may look a bit complicated. The pair was driven down by the general weakness of the US currency. In addition, Japanese yen has managed to strengthen on a scandal involving a land deal and the wife of Japanese Prime Minister Shinzo Abe. This scandal harmed Prime Minister's reputation, and it is an interesting phenomenon that the yen is used as a safe haven and is strengthening versus the US dollar, even when the risks come from Japan itself. Also, I'd like to point out that this week is the last week of Japanese fiscal year, so Japanese companies and investors are continuing to repatriate their profit which was gained abroad. So they are buying Japanese yen, and this is a contributing factor to the appreciation of Japanese currency and the weakness of dollar yen. So this is what we can say on the part of yen's strength. At the same time, we know that the US dollar keeps being supported by the widening US-Japanese interest rate spreads. The Bank of Japan Governor Kuroda gave some dovish comments. He pointed out that Japanese economic recovery still lacks momentum, and that inflation remains far from its 2% target. It means that Japanese central bank is not planning to withdraw its massive stimulus anytime soon. And this is a very different policy stance compared to the Fed's rate hikes. This is why, to understand the policy of the Bank of Japan, to understand the real necessity to continue this extremely accommodative monetary policy, extremely big monetary stimulus, traders will be watching Japanese inflation figures, which will be due on Friday, March 31st. According to a poll by Reuters, core consumer prices have risen in February at the fastest pace in nearly 2 years. And actually, despite these comments from the Bank of Japan, many analysts think that the regulator's next move would be to reduce monetary policy stimulus, and this may actually happen, according to the many analysts, as early as in the next half of this year. This is pretty soon. This is not priced in by the market yet, and despite the fact that the Bank of Japan tried to talk down such possibility, still high inflation will encourage the yen. The yen is currently strengthening on the expectations, and despite the general monetary policy divergence between the Fed and the Bank of Japan, in the short term, the US dollar Japanese yen currency pair obviously has space to weaken to the downside. We see bearish signs, and below the psychological support of 100.25, 100 mark, the 200 week moving average and psychological support. The next support will be around 109. 13 and then 108.20 mark. If we are talking about resistance, then surely 111.50 will be the main hurdle for the pair before the levels of 112.50 and 113.40 will come inside. So the conclusion here is that our outlook for the US dollar Japanese yen currency pair is pretty much negative.